If you're 50 years old with around $500,000 saved, I want you to listen closely because you've probably been told that you're behind. You've seen the articles, the benchmarks, the retirement calculators. They're all saying you need to have at least $1 million, if not 2 million or more, just to retire safely. And if you're not there yet, it's easy to feel like you've failed, like the only option now is to work longer or hope for a miracle. But that mindset, that's the real threat, not your account balance. Because the truth is, it's not about how much you've saved, it's about what you do next with what you've got. So in this video, I'm going to show you the exact move I'd make if I had 500k at age 50, the one strategy that can give you a clear path to retire at 60 without panic, without guesswork, and without needing another $1 million or more. So for those of you who don't know me, my name's John Norberg, and I've helped dozens of people in this exact position through my firm, Norberg Wealth Management, the mid to late career savers who aren't sure if they're ahead, behind, or on track. I've seen the overwhelmed, the am I going to run out of money conversations, and the thing I've learned, you don't need more money. What you need is more clarity. By the end of this video, you'll understand how that one shift in strategy that we're going to talk about can change everything, and more importantly, whether you're already closer to retirement than maybe you think. So with that in mind, welcome to this latest edition of the Financial Prof. So the biggest problem people with 500k at age 50 face isn't more or less money, it's the pressure they feel from outside expectations and internal fear. They're constantly bombarded with messages that tell them they're behind, that $1 million is that magic number, that anything less means they'll have to keep working until they're 70 or forever. And the result is they freeze. They chase bigger and bigger numbers without clarity. They delay the real work of planning because they believe they must reach some arbitrary goal first. And that's expensive in time, in stress, and in missed opportunity. So here is the truth, that 500k can absolutely work if you stop thinking like a saver and start thinking like a planner. Because it's not running out of money, but rather running out of time to build a plan that actually reflects your life. That's the biggest risk. You see, most people fall into this trap because of three deeply flawed beliefs. Beliefs that feel logical, but actually lead to delayed retirements, unnecessary stress, and financial decisions that do more harm than good. So let me walk you through each of them and show you why they might be holding you back, along with so many others, even when you've done the right things for decades. So again, there are three beliefs that we're going to go through, and they keep people stuck, each one quietly pushing you further away from the retirement that you want. The first belief is the magic number, that there's a fixed amount that you absolutely need to retire. One universal target, often $1 million or 1.5 million or more. And what they believe is that if they don't have a million by now, they've already failed. If you don't have enough, you can't retire comfortably. But that's not quite true. You see, those numbers are generic headlines. They seldom account for your actual expenses, your lifestyle, your health status, your expected income sources. They don't reflect your cost of living in your geographical area. And they rarely reflect the fact that Social Security is a piece of the pie too. So what ends up happening is you spend years chasing big numbers, putting off the actual planning steps that matter now. You stay in fear. You oversave in areas that don't matter while undersaving in those that do. And this all prevents you from living the dream that you've been working so hard for. All right, the second belief is that hitting a savings target is more important than understanding your expenses. What people believe is that if they just save more or invest harder or get a raise, they'll make up for anything. And they focus on the number of the nest egg instead of what's the cost of living that they really want to have in retirement. And this is wrong because expenses, especially in retirement, tend to shift. Healthcare costs usually rise. Inflation eats away the dollar's value. Lifestyle changes. You might travel more or decide to downsize, spend more time helping grandchildren. And if you haven't modeled those, then you're guessing. And guesswork is, as you know, very risky. So what ends up happening is you might either underestimate how much you need, leading to shortfalls, or overestimate and stress yourself out trying to hit an impossible goal. Either way, you lose control. You either overshoot or undershoot, risking running out of money or having to keep working. Now, the third belief is that retirement readiness is about crossing a finish line, not designing a path. You see, what people believe is that once they hit a certain age or a certain savings number, everything is just easy street from then on out. But we all know that's not quite the case when we think about it, right? Retirement isn't a sudden event, it's a transition. There are years before and after that need different planning. Also, life is unpredictable. Inflation, taxes, longevity, healthcare, all these things change. And if you don't plan for flexibility, again, you lose. Because once people believe they reach X, they're safe, and they don't do anything else after that, then they become complacent, and oftentimes the risk grows with that. They don't know where to adjust, they don't know where to build, where to conserve, and that ends up oftentimes wrecking what otherwise could have been a beautiful retirement. So in these cases, these beliefs just keep people working longer than they need to. They rob them of options and cause deep regret. And here's something important. You might be doing many things right, saving diligently, investing wisely, and still be stuck. Because the missing piece isn't so much what you do every day as being able to plan for 10 years ahead. So if you're sitting there thinking, this all makes sense, but what does it mean for me? You're not alone. And that's actually why we've created a way for you to get a personalized retirement mapping video tailored around your actual savings, income sources, and goals. It's quick, it's free, and it's for people like you in your 50s, maybe early 60s if you're a little bit further along the journey, with mid-level savings and big questions and desire for clarity. So if you want, click the link below, answer a few questions, and I'll personally walk you through what your retirement path could look like using exactly this framework that we're going to be talking about. So let's shift from what people think they need to what they actually need. If you've got $500,000 at age 50, the goal isn't simply to save like crazy for the next decade, but to plan with precision. What people really want isn't to hit a big arbitrary number, it's to know that they can stop working at age 60 and still live the life they imagine, to retire with confidence, to feel secure. And that's why the one move I'd make, and the one I help clients make, is what I'm going to call retirement mapping for the sake of this video. Excuse me. Retirement mapping is a shift from guessing to modeling, from accumulation to alignment. Instead of focusing on a distant savings target, we map out your actual lifestyle items, income sources, and drawdown strategy so you can see exactly what it takes to retire at 60, and maybe find out if you're closer than you think. This isn't vague or theoretical. It's built on realistic assumptions, your actual numbers, and worst best case scenarios. Because when you stress test your plan, you can have peace of mind. Excuse me. So how does retirement mapping actually work? Step by step. Well, I want you to feel like you're right there building this with me. So let's walk through it. Step 1. Inventory your retirement, lifestyle, and expenses. Make a list of the essential expenses: housing, utilities, food, insurance, regular medical costs, transportation, those items that absolutely must be paid. A good place to start is your most recent credit card and bank statements. Then you list your discretionary or lifestyle expenses: travel, hobbies, gifts, dining out, getting more time for activities you didn't have time for before. And don't forget about the what ifs. How much will healthcare cost later? What about long-term care? What about inflation over the next 10 to 20 years? Even small changes in health or unexpected home repairs, especially earlier in retirement, can add up to a large impact down the road. This is also where working with a professional can come in handy to really zero in on what these expenses are likely to be. So for instance, if you expect to spend 50K a year now on essential costs, and you factor in inflation over the course of the next 20 years, that's going to drastically alter what that $50,000 is going to need to be over the course of the next couple decades. So let's talk about Social Security. When do you plan to claim it? Obviously, age 70 is the latest, but delaying might not necessarily be the best strategy for you. Any pensions, annuities, or other guaranteed income you expect should also be factored in. Part-time work or other income that might continue into or during your early retirement years. You should consider income patches, smaller sources like rental property, royalties, investments that produce dividends, or side business income. These all make up that step 2, guaranteed income. So step 3 is to create and determine and walk through different scenarios. So once you work through filling out income and expenses, now we're going to model several scenarios. such as retiring at 60 or 62, or considering working part-time at age 65, and seeing how each one of these impacts your drawdown percentage on your investments. You also need to stress test with worst-case assumptions, lower market returns, higher inflation, increased healthcare expense, but also this can work in the other direction. What happens if things do go well? Well, then maybe we can spend a little bit more, take another vacation with the grandkids. So step 4 of retirement mapping is developing a withdrawal strategy and addressing risk. Based on the data we've got so far, we'll decide how to use your savings to fill the gaps, systematic withdrawals, bucket strategy, a blend of income sources. The bucket strategy, just to go into that a little bit, is often quite useful. One now bucket with cash or very low risk assets to cover the next year or two of essential expenses. A soon bucket for 3 to 5 years out, more conservatively invested in bonds or safer fixed income like CDs, etc. And then a later bucket for long-term growth, oftentimes stocks or stock-based funds, index funds, etc. Now you also want to make sure you address withdrawal rate risk, not withdrawing too much too soon, because sequence of returns risk matters. If markets drop earlier in retirement, that can massively impact what your portfolio looks like years down the road. You also want to make sure that we're including tax planning expenses. Taxes are a huge part of retirement, and they can make a huge difference if we make slight tweaks like Roth conversions or qualified charitable distributions to the plan. And then the next step, flexibility. You need to plan for things like long-term care, inflation expenses, health care. All of these things can fluctuate or vary wildly from person to person or even scenario to scenario. What the important thing is that you build in flexibility. Plans should be living documents, reassessing every year at least, to find out where life, markets, and your family may have changed and what those needs now translate into for your portfolio. This approach can give you clarity based on what you need, where you are, and what you expect to need. And the reason is because it replaces that indecision, that lack of knowledge and clarity with data. When done right, many people with $500,000 are actually much closer than they imagined. Some are actually surprisingly fragile, meaning that they need to do some catch-up planning based on the retirement they want to have. But either way, by walking through this retirement mapping exercise, you can stop guessing what enough means. You'll know what your enough is, reducing anxiety, stop worrying every night. You'll begin to feel in control. Your decisions aren't reactive. You can steer and shift and adapt because you know what you need to do. And emotionally, it means that you're going from fear and uncertainty to peace of mind, from feeling behind to knowing you're moving on purpose. So if I were 50 years old with around 500K in retirement savings, I would start by creating a retirement map, working through the exercise I've just described so that I would know exactly what I could do if I wanted to retire by age 60. So hopefully you now feel clearer about how one change, one exercise, which is to focus on mapping rather than just numbers, can give you back the control and confidence you've been looking for. Not just chasing a magic number, but creating a plan that actually fits you. But here's the thing. Understanding the concept is just the first step. The real question is, how do you apply this strategy to your own numbers, lifestyle, and timeline? Because unless your plan reflects real spending, income, and goals, it's still just guesswork. And that's why I've put a link below where you can take the next step and see exactly how this applies to you. Click the link and I'll record a personalized video using your numbers to help you visualize what they could mean for you. Thanks for watching, and in the meantime, I'll see you out there.